Hey, I'm Matt Caruso. In this video today, we're going to talk about one of the simplest yet most effective tools any investor can use, the humble moving average. So whether you are a technical analyst, a fundamental analyst, or just someone looking at companies to invest in, you're likely going to see a stock chart. And if there's any type of tool on that chart, it's likely to be a moving average. As a chartered market technician, I spent a good deal of time reading as much as I could about the discipline of technical analysis. And every tool I use is purposely selected. You know, especially as you read book after book and tool after tool, you start to want to avoid tools that have a redundant use. You want to have something that's simple, that you can understand, and that's effective, and that really serves the purpose that you need it to. And I think it's easy to fall victim to throwing up many types of indicators on your chart and, you know, trying to get some kind of signal, some kind of something from the noise. That may sometimes work great on historical charts. Say, oh, look, if I would have bought here and sold there. In real time, it's much more difficult. I found in real time, as someone who has spent his career dealing with risk and trading and surviving off of this business, understanding how your tools work and having a simple approach in real time is absolutely critical. Now, moving averages are just so important because really everybody uses them. Just the general mindset, even if someone doesn't even look at the averages, will think in terms of averages. I've heard many times institutional investors say like, oh, you know, we really love this strategy or this investment vehicle. We put on some exposure, kind of took off. So we're going to wait a little bit for it to kind of ease a little bit to get some better pricing. It's a little extended in the short term. Even if they're not explicitly saying it, I mean, they're basically saying, well, this is just a little too far from what the average price has been recently, so we think it's overdone. We're waiting for a pullback to a moving average. So most people are using a moving average, whether they're putting it on the charts or it's in their internal compass. And that's why I think averages are just so effective, because it really works with human nature. Even if there are long-term trends, those deviations from trends always tend to correct themselves, unless there's some kind of incredible momentum impulse off of a news article or some momentous change like COVID that causes things to fall immediately and in one direction. Most of the time, there's this back and forth as markets slowly price in a trend of earnings or macroeconomic trends, etc. So it's a simple tool, but it can really be used in three key ways. And this is why it's so helpful. And it provides so much information, although it's just one simple tool. You can look at it as support or resistance. We can look at it as a trend identifier. So you can look at it as, you know, whether you're an up or down trend. And you can also look at it in terms of extension as an oscillator, whether you're too far above or too far below this average. So this one average can provide so much information and help you to identify not only what trend are you in, where are prices likely to stop, and whether it's kind of too late to do any buying or too late to do any selling. So let's look at these one at a time and look at some different examples as to how these averages could have been helpful with these different methods. First off, let's take a look at support and resistance. If you take a look at the QQQ, which is a NASDAQ 100 in its bear market of 2022, you can see these really strong rallies that hit major overhead resistance at the 200-day moving average in March of 2022. If you take a look here at the S&P 500, you can also see in August of 2022 on that rally, it hit major resistance. Now, yes, some people will say, oh, it's a self-fulfilling prophecy, and that's why it stops right at that average. Whether that's the case or not, if you're going to be, you know, having to make market decisions, I'll use that self-fulfilling prophecy for my own potential gains if need be. I think in some situations, it's so obvious that that is the case. In many other situations, averages are not a perfect line in the sand. They're more a general area where prices will get to before they find support or resistance. But it's very important to have that on your chart to identify areas where there's a tilt in your direction in terms of what your gains can be versus your loss. I mean, if you're on a key support level, you know, hey, if this does break, I need to exit the position. My losses will be minimal. But if I'm right on trend and this kind of, you know, re-engages upwards, I have sizable gains. So you're ensuring a very good risk to reward type of setup. Another important way that you can use moving averages is trend determination. So you can use crossovers of different averages, or how I like to use it, just simply what average is the stock above? For growth investors, one of the key averages is the 50-day moving average, or on the weekly chart a 10-week average. And simply being above this average will tell you that the trend is up. You're above the average price of the past 10 weeks. And so basically there's net accumulation going on for this stock. Now, we'll discuss a little bit later what's the right average to use. And it does play an important part depending on what your goals are. However, for most growth investors who are looking to put on positions for weeks to months, the 10-week does a phenomenal job. It's the right length to provide space for back and forth movements of the stock as it makes its advance. It's sensitive enough for when the stock breaks below that it's a good reason to get out of the stock. And it's not too sensitive, whereas you're constantly getting these buy and sell signals back and forth. Now, let's take a look at a couple of examples. If you take a look at SE or C Limited in 2020, you can see coming out of the COVID bottom, this was one of the strongest stocks on the market. And obviously with the most people stuck at home and doing their online shopping and living more in a virtual world, someone like C Limited was going to benefit. And you can take a look at this incredible bull run and how C was able to maintain itself above its 10-week average for the entire advance. You could have had, several 100% return just sitting in C and say, I'm going to wait until it breaks below this 10-week average before I sell. So it did a great job of trend determination. Now, obviously, COVID was a great market for trend following. Actually, anything that's news driven, when there's a really big new news item can kick off big trends. So that's typical of trend following systems. However, this is hardly the only time this is the case. If we take a look at First Solar, which is still a popular stock today, or a strong stock as of this recording in 2023, it really kicked off back in 2007 near its IPO. If we take a look at this weekly chart of First Solar, you can see this phenomenal advance as it was exploiting this new trend in solar energy. And we could have had, again, substantial gains in First Solar simply using the 10-week moving average as our reason to be in or out of the stock. Now, some stocks don't move as fast as these growth companies with big earnings, sales growth, where there's institutions chasing them because, wow, it's just an incredible new opportunity. Some companies are much more established, slower moving. And so I need to use another average for these types of companies. And again, we'll discuss it shortly when to use these different averages. But let's take a look at the 200-day moving average. In this example, we can look at Bank of Montreal, BMO, which is one of the big banks in Canada. It's a fairly established business. It's one of the oldest companies in the country. It's essentially operates in an oligopoly where there's just several big banks that account for the majority of the sector in the country. And so this is a slower moving stock, and you're not going to have these incredible runs like First Solar or C Limited. And therefore, you need an average that is less sensitive to the angle of ascent of the stock price. So the 200-day moving average, or the 40-week, which is the equivalent average on the weekly chart, does a great job of identifying when you want to be buying Bank of Montreal and when, if it crosses below, you probably want to step aside or be more cognizant of the risk that this trend is now shifting to the downside. I mean, this doesn't only work with Bank of Montreal. Another, again, big type of utility type stock in the country is BCE. And again, it's somewhat of an oligopoly, only a few other companies in the industry. And you can see as well here, the 200-day average does a great job of really highlighting the best times to be in the stock and when you need to step aside as it crosses below and avoid the risk of substantial downside moves. Now, there are also periods of time, if you're a shorter term investor, you can look at the 21 exponential moving average. So the exponential just means that it gives a little more weight to the most recent day. So it's a little bit quicker to adjust to more recent prices. And if you take a look at these charts, which is the QQQ on a daily chart, or the ARK Innovation Fund, ARKK, which in 2020 and 2022 were both fast moving, given all these incredible runs in the market the past couple of years, the 21 exponential did a phenomenal job of capturing shorter term trends in the market. So if you're a swing trader and you're looking to capture trends from several days, maybe a couple of weeks, the 21 exponential does a great job of identifying the short term trend on your charts. If the stock is below the 21, it's either a time to be risk off or short the stock, or depending on the overall structure. But definitely if you're above the 21 and you're in strong overall trends, that's the best time for shorter term investors to really kind of put on the accelerator and keep their exposure going until it breaks back below the 21 average. So the last way that I like to really use these averages, I mean, we discussed support resistance, we discussed trend identification, is really the extension. And this is really talking now overbought, oversold. And this is usually the realm of oscillators, like we'll talk about in technical analysis. You can look at the RSI, the stochastic, percent R. There's endless number of oscillators. And they're all basically trying to capture the same thing, whether in the short term, the security is overbought or oversold, whether it's gotten too far away from the norm, or whether it's kind of corrected enough that it's ready to buy. And many are effective. I've never really found one that was a super oscillator that did it all. Everyone claims the oscillator that they're using is the best one ever, but in reality, they all act very similar to each other. And therefore, I prefer simplicity. Again, with this one tool, the humble moving average, you can identify trend, support, resistance. And if you take a look simply like at this chart here of the QQQ again, if you look at it in a different light with the 21 exponential moving average, and you take a look at how far it is in percentage terms from its 21-day moving average, you can see overbought and oversold signals. If it's too far above its 21 average, it's likely to correct. And if it's too far below, it's likely to rally. Again, this is likely, and nothing works perfectly. This is really depends on what type of strategy you're implementing. If you're implementing a trend following strategy, selling just because things are a little bit extended to the upside is going to prevent you from capturing the big trends. Obviously, in every major uptrend, there will be periods of time where things get short-term extended. And so that really comes down to the system construction that you're applying. And so no one tool is going to address everything. But if you're looking for a tool to identify, hey, when in the short term is it too extended for me to probably buy the stock? And again, probably most of the time, not all times. The average and the extension from the average does a phenomenal job. Again, let's take a look at some growth stocks. Let's look at the Trade Desk, TTD, and Tesla in these next two examples. And again, these growth stocks on a weekly chart, the 10-week, which is the 50-day average on the weekly chart, does a great job of both identifying trend and also as a guide as to when to back off if it's too extended from this average. So you can take a look at the Trade Desk over the past couple of years and how when it got too extended from its 10-week moving average, it tended to correct. If it didn't correct down to the average, it basically stopped its ascent and consolidated while the average caught up to the price. Very similar story for Tesla. If you take a look at the past couple of years, whenever it gets too extended from the 10-week moving average, it tends to either come back down to that average or it kind of holds into a sideways consolidation pattern until price catches up to it. This is not perfect. So what's the right extension from the average? I found that really it depends on each individual security. Different securities, different stocks have different characters. For example, something like the S&P 500 will not extend nearly as far from an average as a very fast-moving growth stock like Tesla. And so because every stock has a different character, a different level of volatility, a different beta, what I found most effective is you really just want to look at the most recent extensions from the average, what's the maximum points it's extended, and use that as your guide for this stock, for the character of this stock, as to where you will, be cognizant that you're too extended in the short term. I've tried multiple methods trying to put like Bollinger Bands over the extension or Keltner Bands or, draw different types of standard deviations above or below. And I've never really found anything as effective as just simply looking at where does this stock typically extend from its average before running into trouble and using that as my guide. That's what's been most effective for me. And I primarily use this extension as one, holding myself back from FOMO, saying, well, this has gotten a little too far too fast. And if I have a very large position, kind of maybe nudging myself to sell some and take some profits as the drawdown down back to its average can be quite a painful experience. So we really discussed three incredibly helpful ways you can use moving averages. I mean, support resistance, trend, and overbought, oversold extensions. So the next question is, what is the right moving average length to use? What type? So the most common moving averages used are the 8 exponential or the 10 simple day moving average. This is really primarily focused for swing traders, short-term traders, even day traders who want to know where their short-term support resistance. There's the 21 exponential moving average, which is more in the realm of swing traders holding for several days to a couple of weeks. And then once you get beyond that and you're looking for more position trading, well, if you're focusing on growth stocks, the 50-day average is probably the best average for you. It does the best job, like we looked at with Tesla and the trade desk, for identifying, more extended moves. If you're trying to do also, capture more extended moves, but your stock is a lower volatility, maybe it's a high dividend yielding stock, or it's a utility company, or just a company with a more mature business where there's less uncertainty, the 200-day average is probably the best average to use for that type of analysis. So I think taking a second to figure out how you want to use this average in your strategy, what your anticipated holding period is, what type of stock you're looking to focus on, whether it's a aggressive growth stock or a value stock or a utility or a high yielding stock. All of these decisions will determine what's the most important average for you to use. I use different averages in my approach for different specific purposes. I'll use the 50-day average to determine whether or not we're in an intermediate up or down trend. I use the 200-day average as a cutoff. Anything below a 200-day average, I don't even want to pay attention to. I mean, it's such a long-term trend that if we're below there, there's probably something substantially wrong with the company, and I'm looking for kind of immediate growth and accumulation. So that's outside my sphere of importance. I'll use a 21-day exponential average to capture short-term pullbacks once I think the main trend is established. So understanding what type of average to use and how you can use it, this simple tool can do so much for an investor. And that's why I think some people who learn a lot of technical analysis will look at some investors who, have just averages on their chart and say, well, how could you get enough information from that? And you'd be surprised how much the humble moving average can tell you about a stock, its position, and what may likely be its future, or at least a low risk way for you to exploit what your thoughts will be about the future. So what type of moving averages are your favorite? How do you use moving averages in your strategy? Please leave a comment below. Again, if you like the video, like, share, subscribe. My aim is to really make this channel into something unique, something special for people who are dedicated to becoming the best they can be as active investors. And I hope this to be a place where I can share my journey, my experiences. We'll be back soon with some more content. Talk soon.